It's not easy to decipher the stock market and figure out why each stock is priced the way it is. And what we mean is, come on. Everybody knows by now that Apple is the world's largest and most successful corporation, the first to reach $1 trillion in value. Perhaps the share price ought to be higher too, right? To be honest, no. Yet the truth is much harder to solve. The current stock price for Apple is $258, whereas that of NVR Incorporated, a company hundreds of times smaller, is $3,000. To answer the question of whether this makes NVR Incorporated more successful than Apple, the quick response is no. Nevertheless, there's more to it than meets the eye. So, what we're referring to is that the stock market is quite difficult to comprehend at first, but with the right information, you'll be able to get the hang of it as you move along. This is Data Dash, and for today's video, this will serve as your beginner's guide in navigating the complex world of the stock market. If you have questions in mind, make sure to watch till the end. Now, before we move forward, please hit the like, subscribe, and bell button to stay updated for more of our crypto uploads for you. In all honesty, the entire stock market indeed appears too complicated at first glance. But there is a rational reason to most of the things. To make a sense out of the stock market, we have to grasp what a stock is in the first place. Let's say that you've been considering opening a business for the past 6 months. The only problem you have is you don't know what business to start. One day on your way to college, a thought strikes your mind. You whip out your phone, jot it down, and then dash back to the house to start making preparations. Your plan to develop your idea into a billion-dollar business appears to be solid. But you shouldn't be popping champagne corks just yet, because you lack the necessary funding. Call a family meeting to pitch your business plan in the hopes that relatives will chip in financially. No one believes you, but your uncle takes a chance on you and places a wager. $10,000 for 20% ownership in return for some cash. This may not seem like much, but it is quite a bit. It's because your uncle just put a monetary value of $50,000 on your questionable idea. You form a company, issue 100,000 shares, and give 20,000 to your uncle. The first step, you create a website and a prototype of your product. You need to raise more money because you will soon run out of money. Rather than just having an idea as you did before, you've developed an idea worth sharing. Now, you don't have to bother your uncle, and you have the freedom to pursue other options, such as approaching higher-ups in the organization. Angel investors, for instance. Angel investors are typically wealthy individuals who are on the lookout for new and promising businesses and entrepreneurs. Similar to sharks in a tank. It's not easy to persuade these individuals to invest in your business, especially given the grim statistics showing that 9 out of 10 startups fail. And you'll have to give an explanation of why you don't fit the norm, after discussing the matter with many seed capitalists. To your luck, you might be able to convince one of them to come aboard. You need to settle on a price though. A company can be valued in 2 ways: before and after receiving funding. This is a lot easier than it sounds. A pre-money valuation is an estimate of a company's value made before receiving any funding. Investment capital is added to the pre-money valuation to arrive at the post-money valuation. An investor will receive a smaller stake in the company if its pre-money valuation is higher. You negotiate with the investor and succeed in getting him to put $1 million into your business at a $2 million post-money valuation. Hence, the investor will get $50,000 of the business. In addition, your uncle's shares will be added to yours, reducing both of your initial stakes. That doesn't mean you'll have less shares. Instead, the corporation will issue the investor 100,000 more shares. As a result, there are now 200,000 shares in total. instead of 100,000, and your percentage ownership has doubled to 40%. With $1 million, you can rent an office and employ a team of designers, engineers, and specialists to finish developing your product. Now that you've gotten everything in order, you're ready to launch your app, service, or whatever it is you've been working on. You have run out of money though. To top it all off, you realize you need a marketing budget and salespeople, and hence set out to solicit further funding. Series B is what you opt for. This time, you get to talk to venture capitalists in person. They aren't your ordinary angel investors. These are the MBA taughting fellas who make their living investing other people's money in startups like yours through venture capital firms. Whatever the case may be, they have finally decided to place a bet on you after many rounds of discussion. Your firm should be worth more now that you have a team and a product ready to go to market. Let's imagine the VC is willing to invest $10 million at a $20 million post-money valuation. That's a reasonable offer, so you'll take it. When a corporation issues an additional 200,000 shares, the value of each shareholder's holdings decreases proportionally. Given that the VC has just acquired 50% of the business, in case you're wondering, 20% from you, 5% from your uncle, and 25% from an angel investor. To this point, no one has suffered a financial loss. To the contrary, prosperity spread to all. For instance, the angel investor put in $500,000 out of a total of $2 million. He now owns a quarter of a $20 million corporation. You've seen 4 times of increase in the value of your investment. In any case, Series C, D, etc. are all fair game. Time has gone, but only a little. Well done. You've finally arrived. Your plan works out wonderfully. Your company is beginning to turn a profit. Keep in mind that your investors are holding out hope that your business will finally reach a size where they can cash out. Not to mention your uncle, whose $10,000 investment has turned into multi-million-dollar windfall. You can now follow Instagram's example and sell out to a large company, or you can try to carve out a niche for yourself. Other options include going public, like Facebook. To put it in another way, that's an initial public offering, or IPO. The only difference is that now anyone may buy your shares, and you don't have to restrict access to the market. Visitors are welcome to stop by anytime. In the event of a share sale, your uncle or that angel investor stands to reap enormous financial rewards. Your shares are tradable on the stock market between investors. Hence, prior to going public, the stock price is settled upon through a mutual agreement between you and the investor. Yet after a company goes public, a different set of circumstances affects its stock price. The market would set the price based on supply and demand. Share value after first public offering. Upon its first public offering in May 2012, Facebook was valued at $104 billion, or $38 per share. However, investors were not on board with the IPO. Despite this, Facebook was still able to have one of the largest IPOs in the country, raising $16 billion. There are too many variables that might affect the demand for and supply of a particular stock for the stock price to reflect the underlying value of the company. Let's pretend for a moment that a global pandemic spreads, prompting the media to speculate and exaggerate about the potential economic impact of the pandemic. That would cause naive investors to sell their shares of stock before the market actually dropped, as predicted by the media. If there were a lot more shares of a given stock, say Facebook, than people wanted to buy, the price would fall because of the stock's oversupply, and that might cause the remaining investors to liquidate their stock before it sinks even further out of fear. Despite the fact that Facebook is not affected by this illness in any way, the stock price of the company fell dramatically. Let's look at another illustration. The company may or may not be able to realize results for the previous quarter, and if it does, that may fall somewhat short of forecasts. That might attract some unfavorable coverage, and that coverage might prompt some investors, especially naive ones, to sell their shares, which would increase the supply of shares, lower the price, and possibly frighten away some professional investors. This is an endless loop. Because of this, a widespread fear in response to a crisis can have a devastating effect on the economy. It's possible that a business won't turn a profit for many years. Yet, due to the fact that it appears to take place in the distant future, it will generate a lot of revenue. Like in the case of Amazon, the price would rise as the investors bought more shares in the expectation of a future payoff. Not only did it take Bezos 20 years to turn a profit, but also made him the wealthiest person on the planet. The stock price of a corporation has potential to skyrocket if its success continues. In February, Berkshire Hathaway's share price reached a record high of $340,000. You read it right. If you want to buy a share of Warren Buffett's company, you'll need $340,000. So, some corporations split their equities, for example, to maintain them appealing even to smaller investors and thereby enhance demand for the stock. Consider Apple, whose stock is trading at $247 right now, but was selling for $649.88 in June of 2014. That's not fair at all, right? In light of the astronomical growth in iPhone sales and the resulting doubling of the company's market capitalization. So let's break that down. Apple stock split 7 for June 1, 2014. As a result of Apple's stock split, each share is now worth only 7 of the original share, resulting in a reduction of $92.7. If you had invested $650 in a single Apple share then, you would now have $72 to invest. While fundamentally nothing has changed, the perception that the stock is more reasonably priced has led to an increase in demand, which in turn should lead to a gain in price. We can't possibly cover everything that could affect the stock price in the video, but here's the catch. The challenge is to determine whether or not the stock price fairly reflects the genuine value of the company. It's not a good idea to put money into anything that's overvalued, since the stock's price will eventually fall to reflect its true worth. If the stock price is lower than the true value of the firm, investing in the stock is a good idea, since the stock price will eventually reflect the true value of the company. Now, if you think we've covered everything you need to know about the stock market, then go ahead and share your thoughts in the comments section below, and we'd be more than glad to join in the conversation. But other than that, thanks for watching. We hope you learned a lot from this video, and if you did, please go ahead and hit the like, subscribe, and bell button to see more of our crypto uploads and news for you. Thanks again for watching, and we'll see you next time.